Hello everyone, I want to welcome you in today's stream. If you can just text me in the chat that you can hear me and that you can hear me and watch my screen, it would be great. You can see we are 3 people, doesn't matter. Those who are not here today, they can obviously watch the recordings later. Okay, so it's a 5 o'clock, 6 o'clock your time. So we're gonna start today. It's going to be about a market liquidity. There is not going to be too much uh, presentations, but we will look in the charts because this is important things to understand. So where we are right now, we already had actually 2 educational webinars. Now we are in the webinars number 3, which is about a market liquidity bias and how to follow a market makers. Next week, we will look for the high probability institutional levels, and slowly we will be putting it all together. So I think that in 1 or 2 months, you will be able to trade. So yeah, so what we're gonna do today? So how the institution trades? We will look at it. We will look to the institutional footprint. Where is liquidity, which is important. Bias based on the liquidity. External to internal liquidity examples, and internal to external, right? And we will look what is a discount and premium zones on the markets, and obviously we will check the chart examples, right? So market makers, which is a CLS company, as I already explained in the previous webinars. They basically are controlling the market. They moving the price, right? So there is in some educational books or some webinars, people saying that it's a buying pressure or selling pressure, that they are sellers, something like that. You will see that it's actually impossible, because if the market is based on what people are doing, if me or you are buying, it would not make sense how precise it is, how it would be complete chaos, right? So yes, true is that basically everything is algorithmic and high frequency trading, right? So CLS is actually only entity which can affect the market price, and they do it and they send it exactly where they need to have it. They always hide their intention until the last moment, right? That's true. That's what they're doing in the consolidations when they are building a interest on the both sides, and they are actually attracting the buyers and sellers to the wrong side of the market, right? However, they leave readable footprint where the price will react next time, right? They always manipulate price up down before price moves up, and always vice versa, price up before it moves down, right? From the first moment of the bullish breakout, they start to selling and redistributing their positions, right? We'll explain a little bit later. So let's go to another slide, right? So yeah, this is just why I was saying that it's everything is algo trading, right? Just to show on this example, we can see, as I was saying, that they always move price up into the liquidity before they go down, right? And again, they do some consolidation, creating interest, trying to attract the people maybe into the longs by breaking this high. However, they react on their previous level, and then they move the price down again, right? So that's what it is actually constantly happening, always up and down, and it's happening on the specific levels, and price reacts exactly in there, right? As said, up and down, right? So this is not possible that if the market is basically free market, and it would be traded based on what me, you, or any other entity just thinks, right? That's all controlled, completely algorithmic by one entity, right? If it is not, it would be completely random and chaotic, and there would not be any price action which would be tradable. It would be completely random and casino, right? So yeah, as said, they always trade above or below liquidity level, right? So where is the liquidity? Liquidity is always above or below, right, old highs, right? So they always dip it into it before they go other side, right? Again, up before they go down, right? And here it was down before they go up. This continued up, right? So yeah, they always leave this footprint, these gaps, right? So how can we be sure that there was a trading by this entity? Is that they leaving these gaps, right? Called fair value gaps, or it could be called 1 2 3 gaps, right? It depends on who was your mentor. Price always returns into the origin of the move for the reaccumulation, right? So, as I said, from the first moment when they create a breakout, they start to distributing their positions, right? So basically, as we can see, we have some consolidation, right? Price is sold sharply in here aggressively, and then from the first moment once they break this, they start to close these shorts, right? They closing it from already from here, right? And then they return for the reaccumulation in here, right? And they reselling again. Also, they are obviously playing the both sides. They are not only one side biased, but again in here we have consolidation, we have expansion, and once it breaks from here, these longs are distributed to the markets, right? And then when the price returns into the origin of the move, where we had this strong departure with these gaps, there are the more orders filled and price moves higher, right? So first touch of these levels is the strongest one, and it's actually possible to trade it even without knowing a bias, right? So what is actually only important is to know where is potential next liquidity targets, right? And where is these levels where the market makers were trading. You can be sure that they will be trading there again, even if these levels are old for months, right? So these levels can be called, you probably heard it, order blocks or supply demand levels, right? And these gaps can be fair value gaps, right? So yeah, that's basically the levels. Now we will look a little bit into the liquidity, right? So this CLS, this company, they always seeks liquidity. That's the only thing what they need to, right? So what they basically do, they always go from the internal liquidity, which is like in the market, into the external, right? Once they reach the external, they go into the internal, right? So the internal liquidity is in the forms of the gaps or highs and lows in the trend direction towards to the higher time frame level, right? Here we have higher time frame level, and yeah, I will go through it as well also a little bit later. And mostly the liquidity goes above or below 50% of that swing, right? So basically we have a price moves down, right? Hits external liquidity, and then it retraces 50% of this move into the internal, right? Into the gaps, right? Then again, we go down, we breaks external liquidity, we retraces 50% into the internal liquidity, into the gaps, right? Again, external, internal, external, internal, right? So basically higher highs, higher lows. That can be a way looking at it. However, mm, thinking it in the terms of the liquidity, in my opinion, gives a better view about the markets, right? Because if we're thinking about just higher highs, higher lows, we might we might would be a little bit trapped sometimes, and not knowing that they mostly looks for for these stop hunts before the price continues lower, right? So yeah, these gaps working also as the supports and the resistances, right? I will be going through these about these in the next webinar. It's in a plan for these gaps and these institutional levels. In this one, we will speak about this liquidity and how to use it to for our context about a market, right? So let's go to another slide. Yeah. So here is a simple liquidity guide, right? So market always goes from the internal to external, from external to internal, right? And this process still repeats ups and down, right? So always goes from the internal to the external liquidity, and from the external liquidity, which where external liquidity is previous days highs, weeks, months highs and lows, which I will show you in the platform. And once the external liquidity reached, price will be offering fair value in the gaps, and fair value lies above or below at least 50% of these swings, right? Or between 69 to 79, right? So now let me show you in the platform. I will actually show it here in the trading view, right? So basically, if the price goes, let's start. Yeah, I actually wanted to show you this, right? This is from the trading view where I have been predicting that the price on the euro, this is on the daily market, daily chart, that price will reach this level, right? And also on the dollar, I was predicting it was in the January 18th, actually a month ago, that price will reach this level, right? So how did I know? Let's see how it played, right? So price actually reached it in there. It took days, and now it's reversing in there. And on the euro, same, right? Has reached this level, right? Why I'm showing this? Not for the purpose to show you that I understand trading or whatever, but I will show you how did I knew that, right? So basically, as I said, if the price reaches external liquidity, then it goes for the internal, right? So let's look at it this way. We have external liquidity has reached in here in this move, right? Then we are going for the internal liquidity. So it means that it needs to go below some lows, which are, as said in the presentation, below a 50% of the swing, right? So we will plot a fib, right? Here is a 50% half, and here is a first level below that liquidity, right? So price basically went there and it went straight into this nice level where we are getting reaction right now. Yeah, so we are actually on this higher time frame, on this one, on this swing, we have reached internal liquidity, but then if we use a fib again and we measure this swing, right? So we are actually on the external of this swing, right? It has reached the external liquidity in here, and we will most likely be repricing into the internal liquidity, right? So price could be going right now for the first liquidity above this 50%, which would be above this high, right? And also, if you look at it this way, we can see that in here we have this gap, right, which I was talking about, that these gaps are actually a clue that the market makers were trading there. Also, if we put it if we connect it with the information that price mostly returns into the origin of the move, right, where it will be reacting, then we already have a slight clue where the price could go, right? So it could go for these swing highs, right, which would be our liquidity in here, right? This could be easily attacked, right? Also, what helps, this was also liquidity, so I'm using the colors like this for that, right? So how do I know if it will go there right now? I do not know yet, but if I go lower time frame, 4 hours, right? So what we got in here, we have reaction on the daily level, and then we have a nice price action, right? We can see that the highs has been broken, right? And we are having a created higher lows and lower highs. Also, if I want to be buying right now, I will be using again my Fibonacci tool to measure premium and the discount. Uh, actually, this is actually later in the presentation. So let me go back to the presentation, and we will continue with this. But it is. Yes. Okay. So yeah. So as said, price mostly reprice at least 50% of the swing, right? So we saw that right now on the chart what we are looking, right? Next one. Yes, here is these examples, right? So depends on the how the market actually was behaving before reaching that external liquidity, and where we have that low around a 50%, right? So as we've been looking on that example on the euro, price has reached that external liquidity, right? When the down below the first low below 50%, right? So why it mostly goes there, right? Because traders, what they're doing, they using, here they could have a level and they think, okay, we are on the 50%, here we will continue, right? But as said on the beginning, the CLS, they always looking at liquidity. So in order to buy and continue the market, they need to dip below the lows, right? So they need to go below it. Now we can have a structure where actually the price uh, when this swing has a bigger pullback in here, right? So we have actually the price reach external, it start to be dropping, right? And here could be maybe some small low, but no, sorry, don't let me confuse you. Here we have the low, which would be around a 61, right? So it will go for it, right? The first significant low, obviously on the time frame where we are looking for. So if it will be on the daily, this will go below that, right? And even here, the third example, if this pullback was even bigger, around 80%, it will reprice all the way down, right? Into the internal liquidity. So here will be most likely some fair value gap. These gaps mostly give you a clue where the price is coming, uh, where the price is coming, right? So let me bring it back to the trading view again. And yeah, so right now we are, as the price has reached this external, it went back into the internal in here, right? On the small time, as we are now on the small time frame, 4 hours, we have reached this liquidity, right? This level, this level, this level. So we are in the internal, and right now external, sorry. And if you want to be buying for the continuation, I would not recommend that, right? Because again, let's put a fib, right? And if you want to be buying, you need to be doing it below a 50%, which is in here, and below the first low. So it would be below this one, right? I would not be drawing my level in here for the buys, because most likely price drops below it, right? Below that. And also, look at it. This level looks much better. Why? Because again, we have these gaps, right? Because the gaps, who did the gaps? Institutions, right? The big players, they can do that. Only they are the entity who makes such a move, right? So that's a footprint which they leave, right? So this level, I don't say that it's not a level. It is, it could be, right? But this one is higher probability because you will have liquidity taken in here. You will be in the 50% of this, below a 50% of the swing, right? A higher probability, and you will be entering in the level where you have this sharp departure, right? So always I suggest to use this, and never be buying in this higher part, right? Although it could mean that you will miss some trades, but it will give you a better probability, or it will give you better advantages to be buying below it, right? Below a 50% always, right? Also, let's look a little bit on the hand side in here, right? You can see in here we had actually this level. Let's look at it on the 1 hour, right? So when the price has moved sharply in here, right? Maybe someone was trying to buy this breakout, right? Continuation up. That those who did it, they was right with the bias that the price will go up. It went up, but look again. If you plot FIP from here to here, and you stick to the rule, you will not be buying in the higher part of this dealing range, which is this part is called premium, this is called discount, but you will be taking only the levels below a 50%, right? That means that you would be entering on here, right? Last down candle before the sharp move. Also you have here this candles with the gaps, right? So that's what supports your entry, right? And you will be entering in here. Okay, so you see now the reaction on this level is not very good, right? We can look some more examples if we go here, for example, on the USD CAD. And I will delete these things. And again, let's start. Okay, so just let's look at this price section in here, right? So we can see that basically from here, the price has, this is also very important. If you have some level where you can see a gaps, right, and starting and breaking the previous highs, if this level has dropped first below the previous lows, right, kind of took out this liquidity, and you have these gaps, this could be a strong level, right? From here, you could be taking a trades in the future. I think there was some reaction possibly, right? Let's look at it. You can see, right, that the price will react here in the future, right? It will not be doing such a strong reactions on these levels or anywhere else. Because why? Because here is a complete origin of the move that has made these breakouts, right? So you can see it's possible, right? And also again, if we are here and we are expecting to price going higher levels, right? Then we draw this, right? Let's, for example, that the price has made this departure. We don't see these gaps on this time frame, but we can see it on the 1 hour, right? So as for example, we had this departure. We would not be again taking a trades unless the price drops below a level, below this 50%, right? So it would be possible to take a trade here. Now we can see it, right? That here was a reaction, but it wasn't that strong, right? In here, it's better to wait for such a move. right? So always look for the trades only in the 50% in the discount, right, or in the premium. So basically, you think about it like when you are buying a car, right? You don't want to be buying a car when it costs more than I don't know, $20,000, right? You want to wait for the cheaper car, right? You don't want to buy here, right? Also, you don't want to be buying this. You want to buy cheaper in the discount, right? And this is still repeats actually everywhere, right? So then we have what? Then we have again breakout, right? And price drop lower. We can see here was a gap, right? Here was a gap, so here would be possible also taking a trade, right, for the long, right? How we know that? Also another thing about a liquidity, how we know where we are going, right? So let's go to the higher time frame. Let me delete all of this. And if the price, let me plot this here, right? So where we are most likely going now on the USD CAD, right? If anyone can say, probably no one. Okay, so we know that we have this dealing range, and where is a first liquidity in the 50%, right? It's here. So most likely we could be reaching this level, right? So what does it mean? That means that we are still bullish, right? We are still bullish until the price takes out this, right? Because why? Because where did we go? We've been here, we've been external, we went internal. Now we are going what? Now we are going again internal, right? In this time frame, it would be actually the internal liquidity in here, right? If you go lower time frame, we would be looking to trade into the external of this, right? So this is also helping in here, right, to create a biased base on this, right? Also in here, and that's what I would be that's actually what I can talk right now, is we have these two equal highs, or relatively like kind of a double bottom top, sorry. So what's mostly traders thinking is that once the price has been rejected somewhere two times, that it's actually a strong level, that it will not come there anywhere. I tell you one thing, this is a best targets, right? So if we still know right now that we did not reach that liquidity in above a 50%, right? Then we would like to be still trading long bias until we reach there. And we want to be entering where? On such levels where the market makers has been trading, right? So if you're looking at it this way, it always requires a lot of patience, right? So we're looking at it this way, and we can see here is a level with strong departure in here, right? You're looking at last candle, right? We also always need to put this in here, right? Are we in the lower? Yes, we are. Did we had the rate? Yes. So now we price could go potentially higher, right? So this is always a good way to look for the market, right? So that's the main thing which I wanted to say today about a liquidity. Uh, that we are always repricing from the external to internal, and we can use this information as our bias, right? So currently, the USD CAD, which we've been looking for right now, is actually moving in the moving from the internal to the external. Where is this that liquidity above a 50%, right? Where we have these highs, there is these two highs, those equal highs, right? And we are going in there, right? So that's an external to the internal. Maybe it's kind of confusing, right? Now let's look at this, right? And this would be internal to external, right? So that's what's actually a little bit different, but actually the same logic, right? So internal to external, this is actually the USD cat, right? So we have the highs left in there, and we have actually broke something, some level. We have broke some level, some short-term high, right? But price reacted on the strong uh, institutional level, and now is going to where for these highs, right? Why? Because there will be money. Because those who saw this breakout, they shorted in here, or they will be shorting in here on the pullback to the 60, 62 or something like that using the FIP, right? They will be using it, and here will be all these stop losses, right? And as we know, this information that basically we still did not reach this 50% in here, we still know that we will most likely go in there, right? So now, if we must a little bit change our thinking, right? Because this really looks like like a breakout, and that the price is going down, right? But still, we are not in here, and we still have this institutional movements up, right? So yeah, so in my opinion, we are still going in there. Let's look to the euro, and also in here, let me delete all of this again, right? And also in here, as we had these, as I was speaking about this double bottom, double top, right? Look at this, exactly. Uh, it was left there on the purpose, right? So the traders then start to be buying in here, right? Everything start to looks bullish, and then the level, you can see how the level is exactly engineered just below it, right? And then that manipulation into it, and price start to move higher, right? So these things are on the markets always, and it's always repeating. And just to know these basics, and you need to practice that, trying to find it where this happened, right? And you will see that you will be able to getting amazing trades, right? So here again, the price can be leaving such levels when you have a multiple previous days highs, right, close to some levels, right? And price still did not reach a external liquidity on the higher time frame. You can be sure that any breakouts down, it's a false, it's a trap to take the traders into the wrong side of the market, right? And then the price will shoot up there, right? So we actually can be taking it two types of the trades, right? So let me just take it back a little bit. And yeah, so once we have a external liquidity reached, so for example, as it happens today on the euro, right? The price makes a sharp move up with strong expansion, and it mostly must reach around a 100% average daily range. Then we can be taking a trades. Obviously, here we need to get the setup right, which I will be explaining later in the webinars, and then we can be targeting that liquidity below a 50%, right? That's a one type of trades, one type of thinking of the markets. And the second type is that if the price still did not reach a higher time frame, 50% swing at least, and that high above that, and we got some highs left in here, and price makes false breaks, right? Then we are entering and targeting these highs, right? Not trying to I suggest not to try to target any big distances, right? It definitely is in my opinion not good idea, because if you look to the USD cat, for example in here, right, if we would be entering like, look, we had this double top in here left, right? and we knew that the price will most likely to go there, right? So we need to find the institutional level, which was the one in here, right? And our trade would be good enough if we put our stop loss below here and we target just this, right? Because yeah, overall the long term we could think that the price will reach this level, and it will most likely reach it. But look what would happen, right? If you enter here and you take your profits in here, you will be out. Then you will have more chances to take a trade, right? If you don't take it in here to take profit, the price will start to reverse, right? Now almost all your profit is gone, right? Then it's still ranging in here. It will be frustrating. You will most likely close half of the position in here instead of closing it completely in here and then taking another chance, right? So that's a one. That's a way to trade this, right? So this is an example how to trade from the internal liquidity to the external, right? Targeting previous days highs, right? And sometimes when you see that the price somewhere left such a double top, you can be sure that there is a stop losses above it. Then you just look left, you look for the strong level. You don't see it on this time frame, but if we go 1 hour, right, was here, this level, right, with these gaps, right? And then you are looking for a break of these structures, right? For these false breaks and origin of the move from where you want to enter and be targeting those who has been trying to sell with their stop loss above this, right? Because they are maybe less informed and they still don't know where the price is going, right? So the Fibo is actually a very powerful tool, right? And then you have again this opportunity to take a trade in here, right? So basically what you need to do is just a target, just measure it on the higher time frame where the price is going, and then you are just waiting on this levels, right, for the targets. Yes, this is very boring because you have the whole week nothing happening, and the Thursday you have the entry, right? So that's why you can watch a few more markets, right, and be targeting them. Now let's look to the euro. And here is actually the opposite, right? So we had here we had the trade from the external because these double bottoms were left in here, right? And then we had the trade from the external to the internal. So it's another example. This is an opposite example. We need to go lower time frame in here, right? Here it was difficult to entry. It was even on the 15 minutes, right? I was speaking about this trade in the previous webinars, and it was in here because we had the Asians. We had again double bottom left in here, right? Here was a Asian session, accumulation, manipulation down into it, right? And then when the price start to react from this level, and you see first gaps, then there is possible to enter, right? Here we have also the break of the structure, the secondary break, you have the gap, right? And there is a possible to enter, right? I actually had this trade. Unfortunately, I wasn't able to hold it. It was just my it would be nice to hold it from here to here, right? The half lot, it would be a couple thousands maybe, but I didn't hold it in here. I actually closed that day in here, right? But then you have another opportunity in here. Then also, as I was speaking right now here on this USD cat, that if you have these double tops, double bottom, you can use them as a target. That was a perfect example in here, right? So look, for example, we are around here in the market, and you still have these two double bottoms in here left, right? So let's look to the lower time frame, and you see that the price was actually price has left that double bottom in here, right? And you are looking for what? You are looking for the correction, right? Let's see if we get it in here, right? See, so now we have this double bottom in here, and we know that the price will most likely come there, right? But you don't short in here, you don't short in here, you don't short even this breakdown here, because why? You know that the price must come above, at least here is a high, this candle has a high above a 50%, right? So at least once we touch this 50% and the price shows you the breakdown with the gap, right? Then you know that it's ready, that the market makers, that the big players playing. Then where is the origin of the move? In here, right? And you targeting these external highs in these external liquidity, right? So then you just doing this and to targeting this, right? Beautiful trade, 2.9 risk rewards, right? Obviously it could be done even better, but this is fine, you know. So yeah, let's continue to this. Yeah, and this is actually what I was talking about, right? So we use a Fibonacci tool to measuring our range, right? It's always the last swing, right? Once the price start to, because you need to wait until the price start to do some pullback, right? And until then you don't know that it's a bottom, and you start to measure in here, right? So we can project our potential pullbacks and the targets, right, on the higher time frame. Let's say we got this on the daily, right? We can see that the price is going on the daily up, is on the daily in here, and then you know that you have another potential 200 pips until the price takes out first high above a 50% in the premium, and then you basically taking a trades from the institutional levels, right, with the tight stops, right, and targeting just those previous days highs, right, and you still repeating it until it reaches this level, right? And then when we are in here, when it is reached, you doing nothing, you wait until you get what? The candle with the fair value gap, right, and some strong break, and then again you measure, you had this swing down, then you have this swing up, and then you measure from here to here again, and you are looking for the shorts, you know, until that, right? So basically basic rules, we use this Fibonacci, and we never buy in the premium. You do not want to buy in here, you want to buy only in here. If you are bullish, you're not buying here, you're buying only below the levels, right? We are looking for the shorts in the premium. So in the premium, you only shorting, right, on the potential. And uh, if we are bearish, price is dropping down, then it's making pullback, you're not shorting here, you will be shorting above the highs in the premium always, right? So yes, there will be opportunities when the market was going down, then it makes some pullback, you know, and then it dropped lower, you know, and you will be thinking, okay, this guy from the webinar is stupid, I missed this trade. Yes, you will probably miss some trades, sometimes it will not happen, but if you stick into these rules, this will give you a great filter for your trades, and your trades will have a higher probabilities, right? So always we using also this MAD concept, accumulation, manipulation, distribution, and it can be done on the week or also on the month and day, right? So yes, let's look a little bit to the charts in the platform right now, and here we will see how perfect and how nicely it actually all works, right? So here we have also, again, I want to show you as much examples as I want to, but honestly, to understand these things, you need to do it by yourself, right? So here we have, let's look at this latest thing, latest possible trade, right? So what we have in here, we can see that the price has moved higher here on the Tuesday. So we plot our Fibonacci tool. We can see here it is in here, right? And then we have this this fair value gap in here. This one, it's a fair value gap from 1 hour, right? So that's why it's showing like that. And then what we can see that the price started to consolidating, then maybe moving a little bit higher, and then it drops where? Look at this. Here we have 50% in here, right? Drops where? Below. It drops below first low, below a 50%, and it starts to react from this fair value gap, right? These gaps are also supports and resistances. So why we know that this could support the price? Because the market makers, big players, has been trading in here, right? Obviously, we do not have to enter the trade just based from here, right? But what we're going to do, we can actually wait for the break of the structure which has happened in here, right? And then we can actually look to the daily open. No, yes, it can be daily open, right? We can see that there was this break and pullback. We have here is a small fair value gap, right? Origin of the move, which broke the structure, right? So this is actually our level in here. Right in here, and from here we can be looking for the trade, right? This would be perfect to hold trade like this, but again, what do I suggest is just targeting this highs in here, right? And the stop loss just right below that, right? It's a decent trade, could be working, right? And again, here is what I was talking later. Accumulation, manipulation, right? Distribution, right? So as you can see, it's not that difficult, but when we don't see these things and we are just here, it can be confusing, right? So yeah, so this would be actually everything for today. And if anyone has any questions, I would wrap it up in here. And here is just a small homework, which I suggest to you to do. And yeah, so find the external liquidity and internal liquidity on hindsight, right? Go backwards into your charts and try to find out where are these, right? Try to measure by Fibonacci tool if the price went for the 50% liquidity lows, right? As we've been speaking, if it is went right, then try to go backwards in the charts and try to find AMD concepts. This is what I was saying last time. Hope someone did it. And do it also for the Asian range and the Monday range, right? So this is what's still repeating, what is very often in there. It's actually this, what I was showing you in this latest trade, right? So this AMD concept, accumulation, manipulation, right? Distribution, right? So it's still repeating. Actually, today also we have accumulation, then manipulation, and the distribution, right? And where is price reacting today? We go 1 hour. Let's check it out in here. Again, institutional level with the gap, right? If we use Fibo from high to lows, we are above a 50%, right? So we can be shorting. So here is our level. These last up candles before the price drop down, right, would be in here where we are potentially going right now. let me show you. So again, remove this fib. Let's use it from here to here, right? Now we have our dealing range in here. Here is a 50%, right? So here would be a first low below this 50%. So I do not suggest to taking long a trade here, but in here we got these gaps, right? And we could see some at least short-term bounce in here, right? So in here potentially could be what? Could be again, because we had liquidity taken, we could have again repriced. If the price reacts in here, we actually gonna have a fib. It's still repeating, right? You see. Then we're gonna have actually the fib. Sorry. From here to here, right? Here will be probably some, again, some swing lows, swing highs, right? Price will react in here, and it will go again for the 50%, which is in here. And what is in there, we can already see it. We might predict it. There will be this gap, right? So this could be a case. So yeah, focus to the gaps. This tells you that the market maker was trading. Focus to the levels which has these strong departures. There mostly will be some kind of reaction, right? Strongest levels are the ones which took out the liquidity first, right? So price always goes up before it drops down, right? Always use the rule: never buy high, never sell low, right? It will protect you from taking a trade in here. Always measure the 50% of the previous swings, right? You should have on every swing the fib, right? And still stick to, no matter what, into the rule: don't buy above 50%, don't sell below 50%, right? So this for today was a kind of a webinar how to filter our trades in the context of the markets where we are right now. Okay, so yeah, this would be it, my friends. And again, make annotations on the charts and put it to your trade journal, right? I will repeat it again. You must have your trade journal. It will fasten your trading process. It will help you to eliminate mistakes and all these things which I was talking about today. You will find them, you will write them down, you will realize them, and you will start to using them. If there is one thing which I would change in my life, in my trading career, is that I would start journaling exactly from the beginning, because it would save me a lot of stress, a lot of time and everything, and I would be maybe successful much earlier. Okay, my friends, so this is it for today, 53 minutes. I hope that it was kind of helpful, not boring. And yeah, subscribe to our channel. And on the Sunday, I will show my market outlook. Have a great rest of the day. Bye bye.